And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning. Welcome to the Hump Day edition of The Real Investment Show. Yep, it's Wednesday already. Can't believe it. One day back. It's already halfway through the week. And before you know it, second best day of the week's tomorrow. Then it's Friday. And whoop, already into the month of September, right? So month of September is going to go pretty quick here as we start to really kind of focus on markets. And again, September tends to be a little bit weaker month in the market. So again, let's, kind of not surprising here what action has been going on. And of course, as we've talked about previously, markets tend to kind of ebb and flow, and there's what we call buying and selling stampedes. And what that is essentially a movement in the markets where you get this kind of string of buying, and during a buying stampede, you'll just have this kind of incessant pace of buying, and every day kind of the market just goes up. And then you have a selling stampede, which is the opposite, which is like it just won't stop going down, right? And that seems to be the case as of late, particularly over these last few days. And historically, what's important about these buying and selling stampede episodes is that they tend to last on average about 14 days, 14 to 20 days, right around that. It's about the average length. Some are shorter, some are obviously longer. Like we had a much longer one, starting from the July lows up to the recent August peaks. And now we're about 13 days right now into this selling stampede in the markets. And this is why it just seems like, day after day, the markets just kind of go down, and it's very challenging. And again, we don't mind it when markets are going up, right? That's good. We just don't like it when markets go down kind of every single day. And that's what's been happening here. But this is very normal relative to the markets. In fact, if we just kind of go back and look at the market this year, we've had just multiples of these buying and selling stampedes that have just occurred. And again, markets will go down so much, and then you're going to get a rally, and then the markets are going to give that up a bit. And of course, the difference is that when you're in a bullish mode, the selling stampedes tend to be a little bit lighter. And the buying stampedes tend to be a little bit longer and stronger. And it's the opposite when you're in kind of a bear market environment like we're in now. Importantly, though, as we just continue to kind of talk about here, I want to be a little bit careful. Yesterday, I was on Fox Business with Charles Payne talking about this very thing, is that markets are getting very oversold here. So again, a reflexive bounce is not going to be a surprise at all. And we want to use that bounce as an opportunity back here towards the 50-day moving average to try to reduce some of that exposure. So, if you're feeling like, right now it's like, I just got to sell something, I got to do something. Sometimes that's not the right time to do things. We're going to get a bounce here in the next couple of days. And, and it could be a fairly strong one, where we get a day or two of a fairly decent bounce. Now, we're probably not going to get a lot more out of it right now. We are kind of in a very challenging period in time at the moment. But any rally here back to around 4,000 on the S&P 500, that's kind of a good target zone to be looking at to reduce some equity risk, raise a little bit of cash. Could markets go higher? Absolutely. But there's a lot of resistance now that's going to be challenging the markets on the way back up. The 100 days right above the 50-day moving average. You got the 200-day where we just failed here recently at the market peak. That 200-day is kind of continuing to trend lower here. So again, you have a lot of downward pressure on prices from overhead moving averages and resistance levels, etc. So that's what I'm saying. Use rallies as an opportunity. If you haven't liked this market this year, if you've been under a lot of pressure, it's okay. Use the rally, raise some cash, reduce some of your exposure, sit back a little bit, and kind of reassess your situation, right? And think about what you're doing and is it the right thing? We have a lot of people that have kind of bought into this whole idea that markets just go up over time. And that, you buy an ETF or whatever and you just sit on it and you just kind of ride it up and down. And that sounds great in theory. And, the kind of the general premise is, markets are going to go up over time. And, the down markets are just part of it. So you just kind of ride that out. Don't worry about it. It sounds easy until you're in the midst of watching your portfolio go down every day. And that's where the realization of losses really kind of start to show up for people. It's easy to negate the, kind of dismiss the loss idea until you're in the midst of it. It's always interesting. There used to be, and still are, there's a lot of these kind of investor profile, risk profile questionnaires that you fill out online, right? And they always ask you is like, well, what would you do if markets are down 10%? Well, during a bull market, everybody always marks those things as like, oh, I'd buy more, I wouldn't sell anything. In the middle of a bear market, if you give the same person that quiz, they'll tell you that they'll sell when markets are down 10%. Because again, when you're in the midst of the decline, reality hits just how devastating monetary losses can be. So, psychology is always a very interesting thing in the markets. And this is what I'm saying is like, look, you've been under a lot of pressure this year. This is where people tend to make mistakes and start to try to sell things they shouldn't sell, try to buy stuff they shouldn't buy. And kind of come up with these theses that, that really don't have a whole lot of merit to them over long term. But this is where just sometimes just stepping back, though, from the markets and just saying, you know what, I'm going to step back here and just kind of reassess my situation, what I'm doing, what I'm trying to achieve. There's nothing wrong with that at all. There's nothing wrong with just taking a step back and reassessing your situation and then trying to come up with a strategy that will work better for you and allow you to sleep better at night. And that's really kind of the key to all of this. If you're worrying about the markets and what's happening in your portfolio, got too much risk in it. And that's where we need to step back and reassess those things. Okay, a couple of things coming up also that we're going to talk about today. There's still a lot of concern. This was one of the things we talked about yesterday on Fox Business is that, when you look forward, earnings still have to come down. And if you take a look at what's been happening with the markets this year so far, markets have been reevaluating valuations at this point. And valuations on a forward basis have come down because prices have declined, but earnings haven't come down yet. And so when we talk about this re-rating or this revaluation of the market, that hasn't occurred yet in reference to earnings expectations, which are still very elevated. And, we were talking about $242 a share in earnings in 2023 just a couple of months ago. Now it's come down to $214, but that's got to come down a lot more here before we start getting in line with what is most likely going to be generated by the economy. If you take a look at what's happening with inflation, that's going to impact earnings. High wages are going to impact earnings. And of course, when you start to slow down consumption and demand because the Fed's hiking interest rates, that's going to impact earnings as well. And that really hasn't been fully compensated for either by Wall Street analysts, which are still very optimistic about forward earnings expectations. They're just assuming the Fed's going to hike rates, navigate this very soft landing, and it's all going to be great. His history says that we're probably going to have a recession next year. And during a recession, you're going to have much more negative impacts to earnings expectations. Those are going to come down a lot more, which would suggest that markets have to lower valuations. And that's going to occur by both a drop in earnings, the E part of the PE valuation calculation. The other side will be a drop in the price to make those align and bring valuations down. So that's one of the bigger risks we've got going into the end of the year. And when we come back from the break, we'll talk a little bit about this economic data we've got going on. We've got a lot of divergences in economic data. A couple of interesting reports out yesterday on the services sector of the economy, which makes up about 80% of the economy. Two measures measuring the same thing, two completely different readings. We'll talk about what that means and which one you should be paying attention to right after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
It's back to school time, and for your high school student, it's time to fill out the infamous FAFSA form for college financial aid. Mistakes could cost you money. Our next virtual Lunch and Learn will help you maximize your free application for financial student aid, the FAFSA. Register now for this free Lunch and Learn with Danny Ratliff and Chris Liebum Thursday, September 15th at noon at realinvestmentadvice.com. Filling out the FAFSA is vital for getting financial aid. Learn how. Register now at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. I'm your host, Lance Roberts, realinvestmentadvice.com. That's where you'll find all of the great stuff, right? I mean, that's where we have our newsletter, our daily market commentary. We just published today's. It's out on the website now. If you're subscribed, you get an email right at 7:30 this morning. Give you a market update, tell you what to expect earnings-wise. Lots of stuff in there every single day. Of course, our latest blog post is out. Michael's article out today talking about the differential between staples and discretionary, kind of what's going on between those two and which one you should bet on. That's on the website now, realinvestmentadvice.com. Always lots of stuff there. Plus, while you're there, just ask a question. We answer every question every day. So always happy to help you out. Just don't ask stupid questions. Because you'll get a stupid answer.
Was it Mad Magazine that had snappy answers to stupid questions?
Yes,
you remember that series?
Exactly. Mad Magazine. That's a magazine they should bring back.
Oh, yeah.
Especially today.
Yeah.
There's so much stuff to write about.
What? Me worry?
Exactly. All right, a couple of things that we were talking about just for the break. Markets are, trying to figure out what's going on with the economy, the Fed, everything else. And we'll talk a little bit more about the Fed in a second. But it's interesting because, on top of the markets trying to figure things out, the problem is that we also get conflicting data. And everybody's trying to figure out from the data right now, what data is important, what's not important, what's going to drive the Fed. Friday's job report was, pretty strong. And, that lifted expectations for the Fed to hike 75 basis points in September. There's about a 72% probability right now that the Fed will hike by 75 basis points at the end of the month. So, strong economic data, that's going to continue to lead in that direction. Weaker economic data, well, that might suggest that the Fed might be a little bit more cautious about hiking rates. Well, and so yesterday, to add to the conundrum, we had two reports on the same sector of the economy come out. We had the ISM, which is the Institute of Supply Management Services Index, and that measures the services non-manufacturing side of the economy. And today, as opposed to the 1970s, when manufacturing made up about 80% of the economy, today services make up about 80% of the economy. Manufacturing is about 20%. So it's an important indicator to tell you about what's going on within the economy, the strength of the overall economy, et cetera. And it showed a fairly decent increase in the services activity. Now, again, if you throw a ball down a hill, I just want to put this into context. If I'm standing on top of a hill and I throw a ball down the hill, it's going to bounce down the hill. It's still going down the hill, but there's going to be points to where it bounces. And that's what's going on with services indexes. And yes, after the first couple of quarters of this year where we saw fairly negative contraction in economic growth, not surprising, still a little bit of a pickup as we get some pent-up demand, back to school activity, et cetera, right? So it bounced a little bit yesterday, showing a fairly strong increase. And it's still it's still, as we talk about in the stock market, the trend is your friend. The trend is still lower. It just bounced on the way down. However, another indicator that came out yesterday from S&P Global, Standard & Poor's. They measure the exact same sector of the economy. They have the non-services, non-manufacturing services side, kind of indicator. And this is the global U.S. services indicator, and it showed actually a fairly steep decline in services. So if you're watching our live stream right now, I've got a chart of this, and I'll explain why this is important. Now, Pantheon Economics, which is the company that produced this chart, they said if we had to choose, we would probably choose ISM over the S&P Global Services. And the question you have to ask yourself is why? Why would you choose that one over the other one? Because it's more bullish. If you actually are, and again, I'll explain this if you're driving, so please don't try to look at your phone while you're driving. It'll get you a ticket or a wreck, one of the two, and I don't want that to happen to you. But I'll explain this to you. But if you're watching our live stream right now on YouTube, you can see this chart. And what's important about this chart is if you look at the global U.S. services by S&P, there are points in time that it diverges from ISM. In other words, the majority of the time, ISM services shows a stronger number than the S&P Global U.S. services. And so if I want to be bullish, I'm going to pick ISM services over the S&P Global, right? Because I want to be bullish, and that gives me a bullish indicator, so I have confirmation bias. The problem with that analysis is that when those divergences occur between ISM and S&P, ISM usually catches down to the S&P. In other words, the S&P Global U.S. Services PMI Index is actually a more accurate indicator historically. Now, this indicator only doesn't have a long history to it, but it's long enough. And it typically leads ISM services when it's declining. So what this suggests is, and again, the important point about this is that what we're talking about going into next year in particular, and we've discussed this before, is that, yes, we had 2 quarters of negative GDP growth in the first half of the year, but that won't be registered as a recession. The recession's still coming. And likely we're going to see a little bounce in economic data. And then once we get into 2023, that's potentially where, and again, there's no absolutes, there's no guarantees. But if you look at the declination and the trends in the economic data, and then, of course, the sheer fact that the Fed is hiking rates to slow economic growth to try to quell inflation, the risk of a recession is fairly high going into 2023. Now, can we avoid a recession? Sure, anything is possible. But if you take a look at, again, the trend of data, kind of where we are within the cycle, what the Fed's doing in particular, tightening their balance sheet, hiking interest rates, that is going to suggest that we are going to have more negative economic trends in 2023. Now, let's extrapolate that out a bit. And again, let's go back to what we're talking about in the first segment, which is talking about earnings expectations. If I'm correct, and again, there's no guarantee I'm correct, but if I'm correct, and we do have slower economic growth because that's what the Fed wants in 2023, then earnings are going to have to decline because you can't sustain high levels of earnings in a slow economic environment because the revenues that lead to earnings are derived from economic activity. So if we're slowing economic activity, if we are trying to quail inflation by doing that, we're going to have slower earnings growth. And that's going to lead to a revaluation of equity prices to justify lower earnings, right? It's just kind of a logical process that we have to go through. And again, I know the markets have not really accounted for all this yet. Now, I want you to be careful with this because, again, there are a lot of things that can happen between now and then. The problem, as we've talked about before, predicting anything more than about 3 days out in the future is pretty pointless because so many things can happen. I mean, just, last week, we were having a whole bunch of stuff going on, and then, now Russia decides to shut off the gas to Europe, right? So it caused a big sell-off on Friday. There's so many moving pieces in the financial markets, whether it's geopolitics or whether it's finance or economics or politics in general, what our politicians do or don't do, what Europe's politicians do or don't do. All those things factor into the markets. You can't separate out politics from the financial market because they're intertwined. You can't separate out economics from the financial markets. You can't separate out geopolitics from the markets because they're intertwined. It's those decisions that lead to economic activity which affect the financial markets. As an example, there's obviously a energy crisis going on in Europe. And this is leading to a 222% increase in electric bills, a 2 trillion euro increase in electric bills in the Eurozone. It's going to be about 20% of GDP. I mean, we're talking about households, over there. And again, over here, we're like, $500, electric bill, no big deal. It's kind of normal. Over there, it's a lot. All right. We talked about before the disparity in income. The reason that everybody hates the U.S. and the reason that everybody wants the U.S. to become socialistic is so that we have the same standard of living they have, which isn't great, by the way. Talked about before, if you earn $30,000 in the U.S., you're in the top 1% of income earners worldwide. So the reason everybody else wants the U.S. to be socialistic and to adopt things like universal health care and all these type of giveaways is because it will lower their standard of living in the U.S. to match that of the Eurozone. We'll all be equal. Be poor, but we'll all be equal. But this is why as Europe implodes right now, because of what's happening, they're talking about radical interventionism, price setting, which Vladimir Putin just calls stupid, and that's true. Suspending derivatives markets, now talking about Europe-wide margin call bailouts. These are the things that can change market dynamics. We'll talk about that when we come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
It's back to school time, and for your high school student, it's time to fill out the infamous FAFSA form for college financial aid. Mistakes could cost you money. Our next virtual Lunch and Learn will help you maximize your free application for financial student aid, the FAFSA. Register now for this free Lunch and Learn with Danny Ratliff and Chris Liebum Thursday, September 15th at noon at realinvestmentadvice.com. Filling out the FAFSA is vital for getting financial aid. Learn how. Register now at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Pennsylvania park goers stunned to see young girl walking an emotional support pet named Wally.
Wally?
Yeah, it's an alligator. There should be some laws around emotional support pet. If your pet will consume other human beings, it should not be an emotional support pet.
The Real Investment Show podcast. Same show, your schedule.
Look, I love my pets. I've got 2 dogs. I love my dog, but I don't need to haul them around with me everywhere. Just
at realinvestmentadvice.com.
I'm emotionally unstable, but I don't need my dogs everywhere I go.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
It's back to school time for your high school student. Our next virtual Lunch and Learn will help you maximize your free application for financial student aid, the FAFSA. Register now for this free Lunch and Learn Thursday, September 15th at noon at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So just with the break, talking a little bit about markets and repricing as we go into 2023 and the risk of betting on a bear market crash, right? And this is the majority of questions I've been getting lately is like, well, why do you have any equity exposure at all? Markets are clearly going to crash. We'll have a bear market. You don't know that. Nobody does. And one of the things that will change that dynamic, of course, is that we've been training investors now for the last 12 years that whenever central banks, act, that you want to own stocks because they're going to bail out the financial markets. What they don't want is financial instability. And we've talked about this before. I mean, fighting inflation sounds like a great plan until you bust up the markets. And then once you start busting up the markets, that kills consumer confidence, that throws the economy into a deep recession. And that's the one thing they don't want because that leads to credit problems. And, and this is the point that we are facing now is there's clearly some evidence that the economy is going to slow down. The Federal Reserve is going to hike rates to the point that, they diminish demand in order to quell inflation. Unfortunately, what happens historically is they tend to go too far. They tend to break something in the markets or the economy. And that requires them to start cutting rates. And they, that's one of the interesting things that happens is that when the Fed starts cutting rates, that's not where the market bottoms. Markets are generally pretty much in free fall when the Fed starts cutting rates because markets are declining and the Fed's cutting rates to try to stop the decline in the markets, right? Think about 2020 as an example. So by the time the Fed cuts rates, they're going to start cutting rates fairly aggressively as the market's declining, and generally the market's trough, after the Fed is well into the rate cut cycle, reversing QT, going back to QE, etc. And but again, you don't know when that's going to happen or what's going to cause it. And like I said, what we've got going on in Europe right now as an example of this is that Europe's imploding, right? I mean, they're going to face a severe recession, if not a quote unquote classic depression, because of energy prices. And this is going to cause a lot of problems across the economy. And these surging electric costs are going to wipe out a lot of traders that were not positioned for it. And this is why they're talking about suspending derivatives markets. They're talking about price setting on, gas prices, Europe-wide margin call bailout. So when people get a margin call, what margin is if you don't know, when you borrow something on margin, I'm using debt to buy equities or some derivative. And when that blows up, I've got to pay that back, and I don't have the money for it. So what Europe's talking about is bailing out all these traders that make wrong-sided bets on energy prices, et cetera, blow up, and then they've got to get bailed out. So that's supporting markets. You've removed, by doing that, you remove the consequence of bad decisions. So you increase speculative risk by doing that, because if I'm going to get bailed out, why not take a flyer bet? Think about it this way. If you go to Vegas, as an example, and you walk in the door of a casino in Las Vegas, and the manager walks up to you and says, Mr. Clanton, welcome to, the Las Vegas casino, the Bellagio, pick one, right? You go gamble to your heart's content. Whatever you lose, we'll give it back to you, right? So Brent's got no risk. So why would he not clean out his 401k plan at that point and, bet 32 red on the roulette wheel, right? Because if he loses, he gets his money back. But if he wins, he gets to keep all the profit. So a no-risk position incentivizes more risk, right? So this is what this does in markets. And we saw this clearly after March of 2020 when the Federal Reserve bailed out markets and bailed out the credit markets and bailed out junk bonds and then threw capital into the markets. And then we started giving checks to households. There was no risk, so everybody went and speculated on stocks, right? When there is no risk, it incentivizes more risk. And that's what Europe's doing now. And now, of course, it's only a function of time until that comes back here into the United States. The worse it gets, remember, we export inflation to import deflation, right? And what that means is that the reason that we offshore our labor is to lower costs, because you want too much to work, right? California just passed a law over the weekend. Governor Gavin Newsom signed a bill in California mandating that certain restaurants have to now pay $22 an hour minimum wage to restaurant workers. Certain restaurants. Now, it excluded bread makers for some reason, right? If you make bread, you're exempted. If you have fewer than 100 restaurants, you're exempted. So basically, companies like McDonald's, Subway, Starbucks, those are the ones that get impacted. So what will happen, obviously, is that you're going to see a lot of restaurants close down. And this always has, a negative effect, because you're increasing cost on businesses at a time where people have less money to spend. And again, if you're going to make me pay $22 an hour for minimum wage, that's great. No problem with that. I'm just going to raise the cost of my goods, right? So people don't eat out at McDonald's that much. But these are all the consequences of political action. And they have an impact on economics, which has an impact on earnings, which ultimately has an impact on stock prices. But the problem is you don't know when that reversal of policy is coming. So, lots of bad decisions have been made and will get made. And the problem with trying to bet on a blowout bear market is that you don't know when one morning you wake up and Jerome Powell's on television going, yep, we're dropping rates back to zero and reversing our QE, right? And this market's going to go screaming higher. You're going to go, why? Economy's in shambles. Because that's what we've taught investors to do. You know, it was interesting. I got an email over the weekend from, a listener asking a legitimate question. He says, how do you approach buying stocks in your portfolio? Do you look at fundamentals first or technicals first? And, and I was talking about, just a moment ago, if you ask a stupid question, you get a stupid answer. I seriously, thought about for a moment just responding, just pay attention to the Fed, because that's what we've taught people to do. Nobody pays attention to fundamentals anymore. Valuations, who buys valuations? Technicals, they work. If you're adept at using them, you can certainly use technicals to help navigate markets. But even that's not a surefire bet. We've distorted markets so much because of government interference, political decisions. That's what I was saying before. You can't separate out. You may not agree with the administration, or you may love what the administration is doing. It doesn't matter. But politics have an impact on the financial markets. What they do has an impact on financial markets. Pass a CHIPS bill, right? We're going to pass a bill and we're going to give companies money to build plants here in the States, right? It's going to impact the financial markets. Forgive student loan. That's going to impact financial markets. Gives people more money to spend, right? So these all have impacts. And decisions that we make today don't necessarily have an impact today, but they will have an impact in the future. And so the problem is, and kind of just making a full circle back to where we started, the problem with betting on a bear market and, hey, I'm going to be short the market and I'm just going to ride this puppy down, right? I'm going to buy all kinds of puts and, just when this market crashes, I'm going to kill it. It's going to be awesome. Tomorrow you wake up and you've lost all your money because the Fed did something, or the ECB did something, or the Bank of England did something. And it changes market dynamics. Because nobody pays attention. Look, if we could step the Fed out of the markets, if we could remove the Fed, abolish it, get rid of it, the ECB, the Bank of England, Bank of Japan, we get rid of all these central bankers, the markets would gravitate back to fundamentals because that's what matters. And fundamentals aren't great. Prices are extreme. I'm writing an article right now. I'll have it out in the next week or so, but I was doing this yesterday. Prices are extremely deviated from corporate profits. And even though corporate profits rose in the last quarter, corporate profits, by the way, are hugely subject to future negative revisions. But even though profits rose in the second quarter, that's likely about going to be the peak of corporate profits because there was still that influx coming in of those stimulus checks, et cetera, the kind of the tail end phases of child tax credits and stimulus, all that, people buying stuff. And companies had cut a lot of staff in 2020, 2021. So profit margins were large, right? That's trailing data. Very likely going forward, we're going to see those corporate profit margins start to shrink and pretty rapidly. But these are all the things you got to pay attention to. And the problem, as I said, is betting on a bear market and being one-sided. This is something we talked about before. Is never take a one-sided bet. Is because if you're wrong, it can cost you a lot of money. Be right back after the break.
Get Daily investment news you can use. Delivered at the speed of the internet at realinvestmentadvice.com.
It's back to school time, and for your high school student, it's time to fill out the infamous FAFSA form for college financial aid. Mistakes could cost you money. Our next virtual Lunch and Learn will help you maximize your free application for financial student aid, the FAFSA. Register now for this free Lunch and Learn with Danny Ratliff and Chris Liebum Thursday, September 15th at noon at realinvestmentadvice.com. Filling out the FAFSA is vital for getting financial aid. Learn how. Register now at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So futures are kind of flattish this morning, again, as we kind of grind through this week so far. NASDAQ down about 20 points, Dow's down a couple. Actually, now zero. It's flipping back and forth right now. And this is kind of just, this process that the markets are working through. We're in this, as we started out the show this morning, talking about these buying and selling stampedes. We're just in the middle of one of these selling stampedes at the moment. We've broken an important support at the 50-day moving average. There is a real risk that markets will try to retest lows of July. Yesterday, we closed the market sitting on really important support that goes back to some previous bottoms and tops that we had during the July, some bottoms we had back in May and June, and some tops, the kind of little tops we had in July. So there's some support that we were sitting on at the close yesterday. We need to kind of hold this level. Otherwise, we're going to retest those lows. There's no more support below this until we get to lows. And that's going to be confounding because if you remember, we were talking about here on the show that, during the middle of that July-August rally, that we had retraced 50% of that decline from January, and historically that says that, well, you never retest lows. That's what history says. And it looks like we may retest lows. So this will be the first time, right? So we'll see how this works out. But, blackout's imminent, 75,000 powerless in California as record power usage is sparking a demand problem. PG&E is warning customers that, you've got to cut back on your power consumption or we're going to have to do rolling blackouts. And now that's started. And, that's going to continue to probably, get worse. But as we've talked about before, this is the price that you pay for trying to shift too quickly to a green energy economy, which is much less efficient than coal, gas, or oil, right? And so, you've got to have a bridge. And what's interesting is even Elon Musk is now talking about the need for oil and gas production, saying exactly the same thing. Electric vehicles are fine, but you need a bridge to get from point A to point B. You just can't shut off oil and gas and then go all electric because A, the power grid can't handle it, and B, you can't produce enough of it. And C, now you can't produce enough of the batteries. So this is the whole idea of, green energy and electric vehicles and all that's fantastic. We talked about that on the show before, but you can't just make this switch overnight because, the economy is not built for it. The structure is not built for it. The smart move would have been to go hybrid first, build enough hybrid vehicles to start the transition, and then move into electric or whatever future technology is going to be. And look, it's unlikely to be batteries. Whatever the future holds for, non-ICE engines, it probably won't be batteries. It'll be some other technology that hasn't been invented yet, but will be, because again, there's simply not enough batteries to do what you need to do. Too many people. So we'll see how this works out. But this is one of the problems that is going to impact consumer confidence. It's going to impact consumption. If I'm sitting in my house in the dark, not going to be real happy about it. And again, these are, impacts to the economy. We're just talking about what's happening in Europe right now with consumers about to be hit with 500 euro electric bills. They're not prepared for it. And that's why Europe is talking about all kinds of bailouts and price setting and price caps, which are terrible idea, right? Putting a price cap on something is a terrible idea. I mean, that causes all kinds of other problems. Derivatives markets go to zero once you start price capping stuff because nobody wants to trade that. So, that causes all kinds of financial instability. And so that's coming, right? And again, unintended consequences of actions. Everybody jumped off this electric vehicle bridge without paying attention to the unintended consequences. Well, here they are, And yes, part of this has to do with Russia, but that's an unintended consequence, right? You can't, when you're planning, you have to plan for what happens if we're going to do this. What happens if somebody would actually, shut off some gas, or we have an oil crash, or whatever it is? Can we survive this? And see, we didn't do that. We just said, hey, let's all go jump off this bridge together. We love electric vehicles, even though it's a stupid idea. Let's go jump off this bridge, right? And so everybody did. And so now we're going to pay for those consequences. And this is going to impact markets. Again, it impacts consumer confidence, it impacts consumption, it impacts a whole variety of issues. And so that's coming. But there's also opportunity there, right? Again, there's not enough batteries to go around, which means, you need more lithium for batteries. So, companies producing lithium have been doing very well this year, which is why we own some in our portfolios, right? Companies that are, playing that green side. Look, it doesn't matter whether or not you agree with the green philosophy or whether or not you think it'll work or whatever. That has absolutely nothing to do with anything when it comes to investing. If there is a demand for it, that's going to benefit some companies over others. There's only one sector that's positive this year. Actually, two. Two sectors are positive this year: utilities and energy. Oil and gas. Yeah, the same oil and gas everybody hates, right? That's the only sector outside of utilities that are positive this year. And what are a lot of utilities running? Coal. So, when you take a look at, utilities, definitely not on the green side. Oil and gas, definitely not on the green side. But those are the two sectors that are outperforming. Why are they outperforming? Is because there's a massive demand for that good, caused by a whole variety of issues. This radical shift to green technologies, Europe, what's happening in Russia, Ukraine, all that's impacting all at once, right? So it's always important to separate out politics, understand that politics have a very important factor into the investment decision, but don't let your personal politics interfere with your investment decision, right? It's like, if you have a green bias, right? He's like, I'm not going to own any oil and gas companies because they're evil and I'm all green. That's awesome. You've missed out on a nice return this year. So again, it doesn't matter whether, there's this new show on Netflix where they have these 4 real estate investors and people come in and show them their house and they basically can sell them their house right there on the spot. It's kind of like Shark Tank for real estate. And so this couple shows up and they have an earth house, what they call an earth ship in New Mexico. And it's a fully self-contained house. It has its own greenhouse, all attached to it, 2-bedroom, 2-bath. Very nice. It was a very, very pretty house, right? And so I'm looking at this house going, okay, here's this house out in the middle of, Taos, New Mexico, out in the middle of nowhere. It's like, this thing's got to cost a couple of $1 million, right? And I was way wrong. It was like $900,000. They wanted $900,000 for it. I think it wound up selling for $600,000, something like that. And, the point is that, just because you have a philosophy about one thing, don't let that affect your investment decisions. Because they always don't coincide. And this is why you have to look for where opportunities are and say, okay, look, whether or not you agree with whatever philosophy it is, that doesn't matter. Where's the opportunity? How can I make money off of this? Because that's what we do as investors. It's okay to have your personal politics. That's fine. That doesn't matter what your personal politics are. But where can I make money? That's what's more important. And that's what is being generated. So when you take a look at what's happening in Europe in relation to energy prices and bailouts and all these type of things, the question to ask yourself is like, yeah, that's a terrible idea. But where can I make money off of it? And that's not just in the short term, that's also in the longer term. How's that going to impact markets over the course of the next 12 to 18 months? How is that, compared to what the Fed is doing as well, going to impact markets here? What happens, if something breaks? And what you're talking about here is when you're bailing out margin, when you're bailing out derivatives markets, when you're shuttering things down to try to control prices, there are bets that the markets have made on certain things. And when you start interfering with market function, which is what they're doing, that tends to lead to things breaking in the most unexpected of manners. And that's the risk. So these are things that we're going to be thinking about over the course of the next few weeks as this continues to mature, and we're going to be looking at placing bets accordingly, and opportunistically relative to both where we think the economy will be through the end of the year, but also moving into next year. But these are the things to be thinking about. Where is it that we can make money off of this? Look, I don't have all the answers right now. These are the things that we're talking about daily, in our office. But these are the things that you need to be thinking about as well. And there's lots of opportunity. And it's not necessarily all on the short side either. So, again, as I started out the show talking about, as we wrap up the show talking about, be careful making one-sided bets. If you think the world's coming to an end, it's probably not. Doesn't mean it can't get worse before it gets better, but odds are, and the bet to always make is that things do eventually get better. All right, wraps up the show for the day. Get by the website. Our latest blog post is out talking about staples versus discretionary stocks by Michael Leibowitz this morning. It's on the website now, along with our daily market commentary. The newsletter from this weekend is out as we go through the entire market structure, what we're talking about, what we're looking at. All of our trades are placed in there as well. It's all on the website now, realinvestmentadvice.com. All right, have a great day. See you back here tomorrow with Michael Leibowitz for the Thursday edition of the Real Investment Show. We'll see you then.
If I had a little money, it's a rich man's world. It's a rich man's